The US dollar has been the dominant currency in the global economy for nearly a century, and most of the institutions in the current financial system in the world today were created back in the 1940s at a time when much of the world was still colonized by the Western imperial powers. And they designed these financial institutions at the Bretton Woods Conference in 1944 in a way that guaranteed that the Western economies would have significant influence over the global financial system. And in particular, the United States was given veto power in international financial institutions, and the US dollar was made the global reserve currency. This has given the US and also some other Western countries very significant power in the global financial system. And Washington has turned the dollar into a geopolitical weapon. 1/3 of all countries on Earth are under US sanctions, including 60% of poor countries, which are suffering under US unilateral sanctions, which violate international law. And in addition to imposing sanctions on these countries, which is a form of economic warfare, the US and European countries have also stolen hundreds of billions of dollars of assets belonging to these countries. They have frozen hundreds of billions of dollars of reserves of the central banks of Russia, Venezuela, Afghanistan, Iran, Libya, Syria, North Korea. The list of countries has been growing longer and longer. And moreover, the fact that the dollar is the global reserve currency has also given the United States what's known as an exorbitant privilege, because the US can continue to print more and more money and maintain a massive deficit with the rest of the world and suck in the wealth and the value produced by workers all around the world. Workers in poor countries have to break their back mining minerals and then exporting those minerals in order to get dollars to pay for their imports. Whereas in the United States, the central bank, the Federal Reserve, it can just print those dollars. And these days, it doesn't even need to print physical paper. The vast majority of dollars in existence are just numbers on a computer screen. So this has allowed the US to maintain the biggest deficits that countries have ever run in human history and over decades. And the US pays for those deficits by selling debt in the form of US Treasury securities to foreign investors and selling other financial assets like stocks of US companies. And the fact that the dollar is the global reserve currency guarantees this demand for US financial instruments, which also inflates their value, which means that big billionaire oligarchs in the US have gotten richer and richer and have benefited from the fact that the dollar is the global reserve currency. So in short, this system has benefited Wall Street, it's benefited rich people in the US, it's benefited some rich oligarchs in other countries, and it has hurt the vast majority of people around the world. And that's why more and more countries are seeking an alternative to this system. And one of the main institutions, one of the main groupings of countries that is pushing for an alternative to the dominance of the US dollar is BRICS. BRICS consists of Brazil, Russia, India, China, and South Africa, and it has invited several other countries to join, including Ethiopia, Egypt, Iran, United Arab Emirates, and Saudi Arabia. BRICS has a system in which all members are equal. They have equal representation and equal power, and every year the chair country changes on a rotating basis. In 2024, Russia is the chair of BRICS, and Russia is hosting the annual BRICS summit in the city of Kazan from the 22nd to the 24th of October. And for this summit, the Russian Finance Ministry and Central Bank prepared a special report that proposes plans to fundamentally transform the international monetary and financial system and to create mechanisms that will provide more opportunities for developing countries in the global south, formerly colonized countries, to democratize the global financial institutions so they no longer benefit the rich Western imperialist countries at the expense of the rest of the world. In this special report, Russia proposed the creation of what it calls the BRICS Cross-Border Payment Initiative, BCBPI. This would be a way for members of BRICS to de-dollarize their trade and their international investments and reserves. It would be a way to weaken the hegemony of the US dollar and provide alternatives for developing countries so they no longer have to rely on the US dollar and the United States. They no longer can be sanctioned by the United States. They can pursue independent development paths. Now, later in this analysis today, I'm going to go into granular detail explaining this proposal. But just to summarize it overall, at the heart of this proposal is the idea that members of BRICS are going to create new infrastructure to facilitate cross-border transactions so they can de-dollarize their trade and also de-dollarize their international investments and reserves. And instead of relying on the US dollar, they can use their own national currencies, which can also be a relief for a lot of developing countries because they constantly are worried about getting access to hard currency, getting access to dollars to maintain the value of their currency. If they have a trade deficit, they don't want the value of their currency to fall too drastically. They won't be able to pay for imports of commodities and energy. So this is a short and medium-term solution. And the report also raises the possibility of some kind of international unit of account or international currency. This is still very much something that's being debated, the idea of a BRICS currency. However, the report makes it very clear that if that happens, it's certainly not going to be in the short term. That's something that needs to be planned for the medium to the long term. The report says that one of the possibilities could be the special drawing rights, the SDRs. I'll explain what those are. It's a unit of account that is used by the International Monetary Fund, and the value of it is based on a basket of 5 currencies. However, those are the 5 dominant currencies, mostly of the Western economies, plus Japan and China. So that could be the basis for a potential idea in the future for some kind of supranational currency, a unit of account that can be used to settle trade imbalances. However, this report makes it clear that in the short to the medium term, what BRICS countries will do instead is they will try to create new institutions and also democratize existing institutions to connect commercial banks in countries and also to connect central banks of BRICS members in order to settle trade imbalances and in order to transact in their national currencies. The report also calls for experimenting with new kinds of technologies, including distributed ledger technology like blockchain. And this would be a way of decentralizing some of these networks so they're not only overseen by one institution or one country. And the report calls for experimenting with central bank digital currencies, CBDCs, which would be a way for BRICS members to settle trade imbalances directly through the interchange of their central banks without the need for any international institutions. It can be settled by 2 countries through their central banks. And the report argues that the current international financial framework is very inefficient because it's a monopoly. It's entirely dominated by the US dollar and the US itself, which means that the US justice system has significant influence over the global financial system. So it's calling for democratizing the global financial system, providing alternatives for different countries, and saying that we should use current 21st century technology that can make these transactions faster, more transparent, safer, and cheaper. And the report estimates that this could save tens of billions of dollars per year to BRICS members in fees that they pay to settle these transactions. And this report provides a lot of details as to how this can be done. Now, the report is roughly 50 pages long. I read through all of it. I'm going to summarize the main points today because I think this is a very important document that helps us understand what is being discussed inside BRICS at summits like the October Kazan summit. But before I go through some of the main points of the report, I want to talk a little bit more about BRICS. What is BRICS? This is an organization that is not very well understood. Of course, Western critics who are very anti-China and anti-Russia, they often distort BRICS, but even some supporters of BRICS also don't really understand. And Russia published a statement this October that I think helps to summarize what this institution is. Russia emphasized that BRICS is not seeking a military union. Some Western warhawks have fear-mongered about BRICS and falsely claimed that China and Russia are going to turn it into a military bloc and use it to wage war against the West. That's not what's happening. Russia's foreign ministry made it clear in a statement, quote, BRICS is not, has never been, and is not going to become a military union. BRICS is not even an international organization or an integration structure, but a multinational union of equal members, end quote. This is very important. So it is not a hierarchical system. It is not seeking some kind of military command to wage war. And the statement emphasized that, quote, relations between the BRICS partners are based on equality and mutual respect. And then people may say, okay, fine, it's an equal organization, there's no hierarchy, but what do they do? Well, the statement also emphasized that BRICS has three key pillars. First, politics and security. Second, economics and finance. And third, cultural and humanitarian cooperation. Now, of course, those are important issues, but personally, from my study of BRICS over the years, I think the most important element of BRICS cooperation is in terms of economics and finance. BRICS is a platform for developing countries, formerly colonized countries in the global south, and also countries like Russia who were devastated through Western intervention in the 1990s. It's a way for these countries to get together and to create opportunities for economic development, for cooperation, for trade, for investment, for infrastructure development, for scientific exchange and research. And in particular, BRICS is a platform, it's a way for these developing countries to get together and to create alternatives to the Western-dominated financial institutions that exist in the world today. In this sense, I think we can understand BRICS as part of a lineage going back to the call for a new international economic order in 1974. This has been a demand that has been reiterated every single year since then by formerly colonized countries in the global south. And this was also a demand of the G77, the Group of 77, which was founded originally by 77 formerly colonized countries in the 1960s as an alternative to the West's G7. But since then, it has expanded greatly. And there are now 134 countries, the vast majority of countries on Earth, that are part of the G77. And they have repeatedly called for a new international economic order to democratize the existing financial system, which is why I think it's actually deeply appropriate that in 2024, 50 years later, BRICS has now made this one of its key missions. And BRICS has introduced a tangible plan to try to create a more equitable international monetary and financial system. And at the core of this proposal is a push to de-dollarize, to challenge the dominance of the US dollar as the global reserve currency, and instead allow countries to use their own currencies in cross-border settlement of international trade, and also to use their currencies for investment. So countries are not basically forced by the structure of the international financial system to hold their reserves in their central banks in the form of U.S. Treasury securities, that is U.S. government debt, which is a way of funding the U.S. government's operations and wars around the world and its sanctions. This will allow countries to diversify their international investments, and it will take away one of the most significant geopolitical weapons that has been used by the United States to try to kneecap all of its adversaries. And we've already seen de-dollarization pick up momentum. It's not just something hypothetical, it's happening. A clear example of this is how China has been de-dollarizing its international trade. As of 2023, China settles slightly over half, a slight majority, of its cross-border transactions using renminbi, that is its currency, also known as the yuan, and not US dollars. Now, skeptics may say, well, the US dollar still makes up roughly half of China's cross-border transactions. However, if you look at a chart of how rapidly this has shifted, you can see that as recently as 2010, more than 80% of China's cross-border transactions were conducted using the dollar. And in just 13 years, China reduced that from over 80% to under 50%, and the trend continues to increase. And this is especially the case if you look at China's bilateral trade with Russia. Russia reported in April 2024 that more than 90% of mutual payments being done between China and Russia now use their local currencies, that is the renminbi and the ruble, not US dollars. The same thing has been happening with other members of BRICS. Russia and India have signed agreements to de-dollarize their trade and to use their national currencies, that is the Russian ruble and the Indian rupee. Furthermore, Iran, which is now a member of BRICS as well, signed agreements with Russia to de-dollarize their bilateral trade and use their national currencies. And in 2023, China and Brazil also signed an agreement to de-dollarize their trade and use their local currencies, the Brazilian real and the Chinese renminbi. Brazil's leftist president Lula da Silva has been a very outspoken advocate of de-dollarization. During a visit to China in 2023, Lula made a powerful speech in which he said, quote, "Every night I ask myself why all countries have to base their trade on the dollar." And then he asked, quote, "Why can't we do trade based on our own currencies?" End quote. When Lula made those remarks, he was giving a speech at the New Development Bank, which is the BRICS Bank, which is based in Shanghai. And the current head, the president of the New Development Bank, is the former president of Brazil, Dilma Rousseff, who is from the same left-wing Workers' Party as Lula. And as head of the BRICS Bank, she has pledged that the New Development Bank is going to give out, in the short term, 30% of loans in local currencies. And in the years that come, its goal is to increase that even further and to reduce the use of the dollar and eventually eliminate the use of the dollar and the currencies of non-BRICS members in lending. So clearly inside BRICS, there is a lot of interest in de-dollarization, and countries are seeking new arrangements in which they can trade with their local currencies. But what's interesting is it's not just BRICS. It's countries all across the global south. And in fact, on the African continent, countries are also trying to create a new foreign exchange system that will allow cross-border payments in local currencies. This is referred to as the Pan-African Payment and Settlement System, and it was formally launched in Ghana in 2022. The same thing is happening in Southeast Asia. ASEAN, the Association of Southeast Asian Nations, held a historic summit in Indonesia in 2023, and there they signed an agreement that pushed for the creation of new institutions to connect payment systems of the different countries in Southeast Asia so they can use their local currencies in cross-border transactions, and it's a way of transitioning away from the US dollar. So there clearly is a whole lot of interest all around the world, especially in developing countries, that are seeking alternatives to the US dollar-dominated financial system. And this brings us back to the report that was prepared by the Russian Finance Ministry and the Bank of Russia that calls for the improvement of the international monetary and financial system that was prepared for the 2024 BRICS Summit in Kazan, Russia. Now, I want to start here by going through the executive summary of this report, which is 48 pages long. I will go through some of the details, but given its length, we'll just start with the basic summary. The report begins by emphasizing that the international monetary and financial system is inefficient. Not only is it unfair and unjust, it is actually inefficient. It is 100 years old and it needs updating. And the key problem with this system is the excessive reliance on a single currency and a centralized financial infrastructure. This system hurts emerging markets and developing economies. Now, throughout this report, which is written by economists who love acronyms, you can see that they use dozens of different acronyms. It might be confusing to people who don't spend a lot of time, like nerds like me, who read through these lengthy reports written by central banks and finance ministries. As I go through, I'll try to explain what these acronyms are. So EMDES is emerging markets and developing economies. And this report emphasizes that the current international financial system is set up in a way so profits generated from growing trade are invested abroad largely in the rich Western economies, which have more liquid and accessible markets, rather than the growing domestic economies of the global South nations. So this is a fundamental problem that I'll talk about later, how the rich imperialist nations that colonized much of the world are benefiting from these capital flows. There is a net drain of wealth from the emerging markets and developing economies, from the formerly colonized countries. There is capital leaving those poor countries and going to the rich countries, whereas that capital should stay in the poorer countries. That capital should be invested to develop these countries. But instead, that's not what's happening. And a big reason for that is because of the structure of the international financial system, which again was created by the Western colonialist countries and benefits them. It was created in their interest. What this report also emphasizes is that, especially in recent years with the new Cold War, the US trade war against China, and the use of sanctions as a weapon all around the world, again, 1/3 of countries on Earth are under illegal unilateral US sanctions, including 60% of poor countries. And then, of course, with the proxy war between NATO and Russia in Ukraine, this has led to a fragmentation of global trade. And this means that there is a desperate need for new cross-border payments infrastructure that will provide a true alternative to the current prevailing model that is based on centralized settlement mechanisms and reserve currencies that are monopolized essentially by a single institution, that is the US dollar, the US Central Bank, the Federal Reserve. This report says that the future cross-border payment infrastructure could be developed with two different frameworks. First of all, a new messaging system to replace the SWIFT interbank messaging system, which is dominated by the United States. And then also the creation of a new network with a focus on settlement in national currencies. And this new network can connect global commercial banks so they can conduct cross-border transactions in local currencies. And it will provide a new infrastructure to connect central banks, putting central banks in the middle of transactions, establishing links between them, which is a way of minimizing risks, and it's a way of circumventing sanctions. So the US and Europe cannot simply sanction countries into oblivion and try to cut off their commercial banks from existing infrastructure like the SWIFT interbank messaging system, if a new infrastructure is created that directly connects central banks, it doesn't matter if they're under sanctions, because the Russian central bank and the People's Bank of China, they can settle any trade imbalances directly. It doesn't matter if their commercial banks are under US sanctions. And this gets back to what I mentioned earlier, which Russia, as the chair of BRICS in 2024, proposed what it calls a BRICS cross-border payment initiative project. And the Bank of Russia presented this proposal to the other central banks of the BRICS countries, and they call for the establishment of a common multilateral settlement platform based on modern technologies that will greatly reduce risks and accelerate cross-border payment initiatives. What's also interesting about this is that clearly these Russian economists have thought very hard and long about this very important issue. And not only are they trying to de-dollarize international trade, but they also want to de-dollarize investment. So they call for creating new investment vehicles, new financial instruments in BRICS countries that are denominated in the currencies of BRICS countries. And in this vein, they recognize that there are many problems in the existing capital markets, especially the excessive centralization in the West, and the fact that in order to reach a capital market of a developing country, so for instance, if an investor in Brazil wants to invest in Russia, they usually have to route their investment flow via the dominant investment hubs such as London or New York. So those capital flows have to go through correspondent banks and financial institutions between Brazil and London, or Brazil and New York, and then New York and Russia, or London and Moscow. But of course, now with Western sanctions, it's very difficult to get access to the capital markets in Moscow. So this is a call for decentralizing existing capital market infrastructure. And also, the report emphasizes stimulating cross-border investment flows among emerging markets and developing economies. So instead of simply the rich people in Brazil investing in financial assets on Wall Street, which benefits the US, it makes the value of US financial assets go up, and it does not help the Brazilian economy. Instead, the BRICS, in this proposal, BRICS is trying to encourage more investment between and among different developing economies. Formerly colonized countries in the global south should invest in each other to help to industrialize their countries and stop benefiting the rich Western economies. And to do so, this report proposes creating a new architecture, and they refer to this as the BRICS Clear platform, which would be an electronic system of interdepository interaction. And later I'll talk about what that means. What is this proposal for the BRICS Clear platform? And in the same vein, BRICS is discussing ways to try to diversify the reserves held by central banks around the world, which have much too high a concentration of US dollars. And this report emphasizes that the US dollar is the global reserve currency. However, the interests of the United States are not always aligned with the interests of other participants in the international monetary and financial system. I would say nearly always not aligned. So there clearly needs to be alternatives. And furthermore, this proposal calls for creating a new development funding model, especially considering that developing countries are existing in a global system that is very unfair, that poor countries have to pay the highest interest rates to borrow money, even though they're the ones who need investment the most in order to develop infrastructure and invest in healthcare and education. So what we see is that, for instance, the net interest payments in developing countries on average accounted for 7.8% of government revenues in 2023, which is up from 4.2% in 2010, and most of these countries are borrowing in foreign currencies like the US dollar or the euro, and that creates a lot of risks, especially in a moment like in the past 2 years. Since 2022, the US Central Bank, the Federal Reserve, significantly raised interest rates, and the European Central Bank raised interest rates, which made other currencies fall against the US dollar and the euro unless central banks in the global south also significantly raise their interest rates, which would crush their economy. So what that meant is that as local currencies fell against the dollar or the euro, it made it even harder for these poor countries to pay off their dollar-denominated debt or euro-denominated debt at a time when they're paying very high interest rates, higher than the rich countries of the West, which, by the way, the Western economies are much more heavily indebted than most of the poorer countries. The US federal debt is 122% of GDP, which is way higher than most developing countries, most global south countries. And yet the US government is able to borrow at much lower interest rates than developing countries. This system is clearly completely unfair, which is why BRICS is trying to create new alternative infrastructure that will benefit global south countries and not just the rich Western economies. As part of this, BRICS points out that there is a need for multilateral development banks. However, the problem with existing multilateral development banks is their governance, the insufficient voice and representation of the global south countries, and that's why there is a need for the New Development Bank, the BRICS Bank, and they say that the New Development Bank can be an example to other multilateral development banks. And in the same vein, another huge problem is the International Monetary Fund, the IMF. This report emphasizes that the IMF's governance structure is completely undemocratic. It provides significant advantage to high-income economies. So as an example, the interests of 35 rich advanced economies are represented by 12 directors in the IMF, whereas the remaining 155 countries in the global south are represented by 12 directors, the same number as 35 rich countries, or they're simply included as part of the larger group of the rich countries, and their opinions and interests are considered secondary. They're not listened to. And by the way, while the World Bank and IMF claim to supposedly be multilateral, in reality, they're completely dominated by the West. Every single president of the World Bank in history has been American, has been a US citizen, and every single managing director of the IMF has been European. That's the deal. The World Bank is run by an American, the IMF is run by a European. Even though they only represent together about 12, 13% of the global population, they don't really care about the rest of the world, which is in the global south, which is the global majority, which represents 85% of the global population. But there's only one country that has veto power in both the IMF and the World Bank, and that is the United States, the only country, which is a clear sign of who is really in charge. And you can also look at how absurdly undemocratic the IMF voting process is. So the G7 countries, the Western colonial powers and Japan, together, they have 41% of the entire voting share in all of the IMF, despite the fact that they now only make up around 30% of global GDP measured at purchasing power parity. Whereas the BRICS countries, together, they represent 32% of the global economy, more than the G7 economies, but together, they only have 13.5% voting share. So the G7 has 41% of the votes in the IMF. BRICS has 13.5%, despite the fact that BRICS economies are larger together than the G7 economies. This is fundamentally undemocratic, and it is neo-colonial. The IMF and the World Bank were created by the Western colonial powers to serve their interests, and that's exactly what they do. And this is why so many countries are seeking alternatives. BRICS, in fact, did already create an alternative to the IMF, which is called the CRA, the Contingent Reserve Agreement. However, when it was designed by Western-trained economists who didn't really see this as a significant alternative. They basically modeled it after the IMF, and it is hindered by some very significant problems, including the fact that it relies on the US dollar, and it has to get permission from the IMF. So this report emphasizes the existing problems with the BRICS Contingent Reserve Agreement, the IMF alternative, the CRA, and proposes ways to democratize and reform the CRA so it's an actual alternative to the IMF. And finally, in this summary, the report emphasizes that these very real problems in the structure of the international monetary and financial system have resulted in a growing economic imbalance between the developed and developing economies, slowing progress towards sustainable development goals, fragmenting the system. What this means is that rich countries have gotten richer and poor countries are trying to develop, but it's very difficult because of the structure of the system. It's not because they're lazy, these arrogant Western, neoliberals who say, oh, they should just pick themselves up by their bootstraps. No, it's because the structure was designed in a way that benefited the rich countries at the expense of the poor ones, and that's why there needs to be an alternative. And this report is a very significant step toward trying to develop one. So let's dig into greater detail here in this report written by Russia's Finance Ministry and Central Bank for the BRICS Summit in 2024. It emphasizes that the global economy has changed a lot in recent decades. In fact, as of 2023, emerging markets account for slightly over half of global GDP, 50.1%, and 66% of global GDP growth over the past decade. BRICS countries in particular have gone from representing 22% of global GDP, measured at purchasing power parity in 2006, to now 32% as of 2024. That is, the original 5 BRICS members, Brazil, Russia, India, China, and South Africa, together represent nearly 1/3 of the global economy. And at the same time, the G7, the group of 7 colonialist countries that colonized much of the world, that's the West plus Japan, the G7's share of the global economy has declined and is now less than 30% of global GDP. So the BRICS 5 are bigger than the G7. However, as these economies have changed, the international structures of the financial system have not changed. They're basically the same structures that were created in the early 20th century. And what have these structures led to? The report emphasizes they have led to frequent crises, persistent trade and current account imbalances. That is, certain countries like the US are able to maintain these massive current account deficits, a trade deficit with the rest of the world, sucking in the wealth produced by workers around the world, because the inverse of a current account deficit is a capital account surplus. So there's a constant flow of capital going into the United States, being invested in US assets, US bonds, which fund the US government deficit. And there's all that investment keeps US bond yields, the interest rate, low, which means that the US government is able to maintain these massive deficits. And it also means that US assets like stocks, also real estate and other assets, have massively been inflated in value, which have made rich people even richer and has also massively contributed to income inequality. The reason that this system is able to be maintained is because of the structure of the global financial system. It has also led to volatility of capital flows and exchange rates. So in poor countries and developing countries in the global south, whenever there's some kind of crisis, you often have massive capital flight. And what happens? The value of the currency collapses against the dollar. And of course, a lot of that capital goes into investing on Wall Street. So the US benefits, and these poor countries constantly have exchange rate crises. So this report emphasizes that, quote, the current international monetary and financial system is primarily serving interests of advanced economies, end quote. And what does this mean? It has ultimately, quote, resulted in a growing economic imbalance between advanced economies and emerging markets in developing economies, lagging sustainable development goal progress, and a fragmenting system, end quote. The report includes two interesting charts which, when taken together, show how trade flows have changed much more than investment flows. So, in the past few decades, trade between developing economies has massively increased from 10% of total global trade in 1995 to 26% as of 2022, and they estimate that will continue to increase to 1/3 of all global trade as of 2032. And BRICS trade is, as of 2022, intra-BRICS trade, that is trade among the various members of BRICS, is 8% of global trade and is estimated to increase to roughly 20% as of 2032. So more and more developing economies are trading among each other. However, we have not seen very much diversification of international investment. It's still largely advanced economies that invest in other advanced economies. And also importantly, there is more investment from developing economies to advanced economies than there is from developing economies to other developing economies. That is to say that many institutions in emerging markets and developing economies are investing in the rich countries that already have enough capital. They don't need foreign capital. It's the developing economies that are usually capital scarce. They want more capital in order to invest in infrastructure and development and industrialization. And there was a very interesting research paper published by economists at the World Inequality Lab in April 2024 that explains how U.S. exorbitant privilege has become a rich world privilege. It demonstrates how wealth is drained out of the global south and toward the global north, benefiting rich elites and inflating the value of financial assets in capital markets in the West. As the economists put it in this report, quote, U.S. privilege has become a rich world privilege financed by the BRICS, end quote. What their chart shows is the difference in foreign capital income received in these countries. So what happens is that capital flows out of the BRICS countries and it flows into the US, the Eurozone, and Japan and is invested in financial assets in those countries. And it generates an excess yield income for the rich economies. And then there's a negative yield income in the BRICS countries. So it's draining that wealth out of BRICS toward the rich countries in the global north that colonize the world. What this amounts to is trillions of dollars. We are talking about huge sums of wealth, representing 5% of Japan's entire GDP and 2% of the GDP of the US and the Eurozone, whereas it's draining 3% of the GDP of Russia, 3% of the BRICS countries, and 2% of the GDP of China. There's another incredible chart in this study that makes it even clearer how the poorer countries of the world have their wealth being drained by the rich countries. So it shows how the top 20% of countries, the richest 20% of countries, are receiving net foreign capital income of more than 1% of GDP. And poorer countries are losing 2 to 4% of GDP in capital income. And again, this is because rich people and financial institutions in these poorer countries are investing their capital in financial assets in rich countries, and that is benefiting rich people in the rich countries. It's also benefiting Western governments, which can borrow at lower interest rates, and it's hurting poor countries, which have to borrow at higher interest rates. So I wanted to just briefly look at that report from these economists at the World Inequality Lab because it demonstrates why there is such a need for new infrastructure, new alternatives in the global financial system, and how it structurally benefits the rich imperialist countries at the expense of the poor, formerly colonized countries. So getting back to the other report compiled by the Russian government, its proposals in the BRICS summit, another point that this raises is the inefficiency of the existing cross-border payments infrastructure. First of all, it's a monopoly dominated by the US dollar, and there's a lack of competition. You know, it's funny, Western neoliberal free market fundamentalist economists love to talk about the problems of monopolies and the need for competition, but they don't actually want competition when it comes to the financial institutions, the structure which benefits the US. They want that to all stay the same. But this report emphasizes that there is currently a system that has an unchallenged centralized decision-making authority concentrated in the United States. And this means that participants in the system not only have to endure higher transactional costs, but they also risk being excluded from the system in the form of US sanctions and restrictions. And one of the reasons that this system is so antiquated is because of new technology. This report points out that in the early 20th century, when the system was created, there was global information asymmetry. It was very difficult to get information about global financial markets and, for instance, the value of currencies against each other that were, at that time they were not freely floating. But the point is that you couldn't just see the value of the US dollar against the yuan or the value of the rupee against the ruble. You couldn't just see that immediately. You had to get access to these complicated books and magazines that they were publishing that only certain institutions got access to that would say, this is the exchange rate. And also at this time, this is when these exchange rates were fixed. So the point is that today it should be much easier to facilitate cross-border payments. And this information asymmetry is much less of a problem compared to just a few decades ago. A clear example of this inefficiency is the use of correspondent banks that act as intermediaries. What does that mean? Well, it means that if you're living in Turkey and you want to do a transaction with someone in Brazil, and you have a Turkish bank and your trading partner has a Brazilian bank, how are your banks going to communicate? How are they going to do their cross-border transaction? Well, what usually happens is that the Brazilian bank has a correspondent bank, which is almost always located in the United States, like in New York. So the Brazilian bank, it sends the transaction to the New York bank, which processes it, and then it sends it to a Turkish bank. So the Turkish bank and the Brazilian bank don't have any direct ties between each other. But they do have ties to this New York bank. So that's the correspondent bank. And they process the transaction through the New York bank, which means that the New York bank is profiting from this, by the way. And it also means that the US claims that this transaction digitally touches US territory, in scare quotes, which means that all of these transactions have to abide by US laws, which means that the US says you're not allowed to do trade with Cuba or Iran or Venezuela or Russia, these sanctioned countries. And you're not allowed to do transactions with sanctioned companies like China's Huawei. So the US uses the fact that its correspondent banks are the intermediaries to weaponize this infrastructure. So first of all, this is politically dangerous for countries. But furthermore, it's also very inefficient, especially in the 21st century. So this report says the speed of the execution of these payments depends on the operating hours of the banks, like when banks are closed. And it also depends on the national standards of the intermediate banks. So payments are executed very slowly and inefficiently. And this should be changed. We should be using more modern technology. And then related to that is the problem of financial messaging. So the vast majority of banks around the world communicate with each other through the SWIFT interbank messaging system, which is ostensibly based in Belgium, but it's really controlled by the United States. So first of all, this leads to time delays and high costs. But even more worryingly, this means that countries whose banks are communicating through SWIFT are subject to illegal unilateral sanctions. As the report points out, even if the transaction takes place between two non-US counterparts and involves no US currency and non-US financial infrastructure, even if it's a Brazilian bank communicating with a Turkish bank through the SWIFT system, it doesn't matter. Even if it's not using this correspondent bank in New York, even if the Brazilian and the Turkish bank communicate through the SWIFT system, they're still subjecting themselves to US law because the US says that any banks that use SWIFT have to abide by US law, US sanctions, and European sanctions because it's based in Belgium. And of course, Europe obediently follows the US in applying these illegal unilateral sanctions on many countries around the world. So to try to solve this problem, the report emphasizes that there should be new cross-border payment infrastructure developed, and then countries that are trading with each other can seek another unit of value. And it emphasizes that this unit of value does not need to be limited to national currencies, but it can be a range of things. So central banks can directly settle trade imbalances through central bank digital currencies, which cuts out the need for an intermediate bank, and it cuts out the need for an interbank messaging system. It's just a direct communication between central banks. They can use asset-backed tokens, which they talk about a little later, or they can use currency baskets. So instead of trading or settling trade imbalances directly in rubles or yuan, instead they can have a basket of different currencies that they settle their trade imbalances in. And this report emphasizes the same thing for reserves, the foreign exchange reserves held by central banks around the world. It emphasizes that there are endless options for reserve composition that involve an array of asset classes that vary from conventional currencies, debt, and gold to more novel assets. And it says that reserve holders should be more flexible regarding their FX allocation, their foreign exchange allocation. And they point out, by the way, that the current international reserve asset, the biggest asset that is held by central banks around the world, is US Treasury securities, US government debt. However, it points out that this actually has not been a very good investment. So while on paper, a US Treasury security may seem like a very stable investment, if you actually look at the returns compared to inflation, the real returns, you can see that they have not been very good for the past 2 decades. So what does this mean? Well, there's a chart here that shows the yield on a 10-year US Treasury security, a US Treasury note, as it's called. A Treasury bill would be up to 1 year, a Treasury bond is 20 or 30 years, and a Treasury note is 2, 3, 5, 7, and 10 years. So if you look at the yield, the percentage yield on 10-year Treasuries, you can see that in the 2000s, they were consistently higher than inflation. The other part of this chart is the median consumer price index in the United States. However, you can see that after the financial crisis in 2008, the central bank, the Federal Reserve, dropped interest rates very low. The federal funds rate went to 0. And then the Fed began the infamous quantitative easing policy, which was a way of maintaining very low yields on Treasury securities because the Fed would just print money digitally and then use that to buy US Treasury securities, which would reduce the market yield on Treasury securities, which makes it easier for the US government to fund itself and maintain these huge deficits. So what you saw throughout the 2010s is that basically there was no real yield on a 10-year Treasury security. In fact, in some years, like in 2016, if you held a 10-year US Treasury note, you were losing value because inflation was higher than the interest that you were being paid, the yield you were being paid. And this is especially the case in the past few years as inflation massively increased during the pandemic. And in 2022, inflation hit over 7% in the United States, but the 10-year yield was only about 2 to 3 or maybe 4%, even when the Fed began raising interest rates to try to deal with inflation. So if you were investing in US Treasury securities, you were losing real value because of inflation. So getting back to this BRICS report, what it's emphasizing here, what it's saying is that it doesn't make sense to keep investing in US government debt when all you're doing is funding the US government. The US government benefits from this. You're not even really making a real yield on this for the most part. It's just a horrible investment, but it's seen as a very stable investment. And this comes back to what's known as the Triffin's dilemma, which is named after a famous Belgian economist who said back in the 1960s, wait a second, if the US dollar is the global reserve currency, but the US dollar is a national currency, there's a fundamental contradiction here. And as the BRICS report puts it, the US dollar is first and foremost the national currency of the United States, and its role as the dominant foreign reserve currency is secondary. This means that the interests of the United States are not always aligned with the interests of other participants of the international monetary and financial system. So clearly, the US Federal Reserve is not setting monetary policy in a way that benefits the world. And that's certainly the case in the past few years as the Fed rapidly raised interest rates, which devastated many poor countries in the global south whose currencies fell against the US dollar because their central bank didn't raise interest rates as rapidly, which would have been a sledgehammer to their economy and caused a recession. And that means that these poor countries in the global south that have dollar-denominated debt, it's become very difficult for them to pay off that debt. And it's become very difficult for them to finance, to pay for their imports, to pay for energy and other commodities that they need to run their society. So clearly there needs to be some kind of alternative to the US dollar that can solve this Triffin's dilemma, this Triffin's paradox. And everything that I've mentioned here, none of this is even to talk about the fundamental problem of weaponization, of the fact that the US government has turned the dollar into a weapon. So all of these economic issues that I've been discussing in the past few minutes have existed for decades. This is not a new problem. But what is relatively new, what has become in recent years a very pressing concern, is the fact that the US government has been stealing the reserves held by central banks around the world. And this BRICS report has a very useful chart that has a timeline of the different countries whose assets were frozen, whose US dollar denominated assets were illegally, unilaterally frozen by the United States, including Iran, had 12 billion US dollars of assets frozen in 1979 in response to its revolution. In 2005, the DPRK, North Korea, had 24 million assets stolen. In 2011, Libya had $168 billion of its assets frozen. Syria in 2012 had $14 billion of its assets frozen. In 2018, Iran had an additional between 100 and 120 billion US dollars of assets frozen. Venezuela in 2018 had 31 tons of gold frozen, and the West, including the Bank of England, has refused to give it back. In 2019, during the US-led coup attempt, another 342 million US dollars of Venezuelan assets were frozen. In 2021, $7 billion of the Afghan central bank's assets were frozen. And then finally, a whole new level was Russia's 300 billion US dollars and euros worth of assets were frozen by the West in 2022. And they're saying that they're going to steal it. and use it to fund the war in Ukraine. So, I mean, we're talking about piracy, international piracy by the Western powers. And this is another very significant reason why so many countries in the global south are seeking alternatives to the US dollar, because they now know that the Western powers will simply steal their dollar and euro denominated assets. They'll steal their central bank reserves if the West doesn't like what the governments of these countries do. Now, here I've spent a lot of time talking about the problems in the existing financial system. So what are some of the more concrete proposals that Russia has made for BRICS? Well, in terms of cross-border payment mechanisms, the Russian proposal emphasizes that there are two different axes that are emphasized. One, a messaging system that is needed as an alternative to SWIFT. And then two, a network of banks to communicate with each other, to transact. So within this framework, the report articulates four different possibilities, which are not necessarily exclusive. They can all be done, or some of them can be done, or just one of them. So the first possibility is developing a network of global commercial banks that can conduct cross-border transactions in local currencies. Pretty easy. We already talked about that. Another possibility is establishing direct links between the central banks in individual countries that cannot be subjected to external pressure. And this means that no single commercial entity in the network can be excluded because it's the central bank itself that is communicating with the other central bank. I'll talk about this idea in a moment. Another proposal which is related is the introduction of distributed ledger technology, that is DLT, which would use modern technologies like tokens backed by national currencies, central bank digital currencies, which could help decentralize the system. So this is basically a way of strengthening the second proposal. So you could have communication between central banks without central bank digital currencies, or making it even easier, you can use modern technologies to communicate between the central banks. And then finally, another proposal that is in this report is the creation of centers for mutual trade in commodity resources. So trade imbalances can be settled with tangible commodities. They can be settled in gold, which historically they've been settled in, but they can also be settled in grain, oil, natural gas, or other possible commodities. So this is a way of saying, Iran, for instance, let's say Iran has a trade deficit with Russia, then they can settle that trade imbalance. Iran can give Russia some kind of petroleum product. Or if India has a trade deficit with Russia, instead of giving Russia a bunch of rupees, which Russia can't necessarily use, it doesn't need a lot of rupees, like what is it going to buy with those rupees? Instead, they can settle this trade imbalance directly through commodity trading, and India can give Russia grains or some kind of mineral that Russia may want. Now, of those different options, this report suggests that the best potential model would be the use of distributed ledger technology, which is basically blockchain, right? It's a way of having a decentralized network, so the information about all the transactions is not located simply in one institution in one country, but instead is decentralized using this technology across many different institutions. What this would do, the report emphasizes, is it would eliminate credit risk. It would also be a major reduction in processing time and costs, and it would result in the absence of correspondent entities, which means the reduction of the threat of the elimination of the threat of sanctions, of extraterritorial pressure by the US. And another very important aspect of this is it's not just political, it's also economic. This report emphasizes that using some kind of distributed ledger technology, blockchain style system, will only cost 1% to 2% of the current conventionally settled system. So that means that they estimate that in BRICS cross-border trade, countries could save 15 billion US dollars every year in terms of the value of their trade that is now spent simply on all of the fees, all of the different transaction costs, all of the delays. And what's important here is this report emphasizes this is not just hypothetical. We are not starting from zero, it says. We see the emergence of bilateral arrangements in local currencies already happening. As an example, this report cites that India and the United Arab Emirates are settling oil trade in rupee, the Indian currency, or Russia and China are settling trade imbalances in ruble and yuan. And it also mentions a very interesting project, which is called Project Dunbar. This is an initiative being overseen by the Bank for International Settlements, the BIS. So, by the way, for people who don't know, a central bank is essentially the bank for the banks, right? So if you're a banker, where does Bank of America have its reserves, right? It's in the central bank, the Federal Reserve. But what is the bank of the global central banks? Well, that's the Bank for International Settlements, the BIS. And for the few years now, it's been experimenting with something called Project Dunbar, which is a way of using a multi-central bank digital currency platform, CBDC platform, shared across different countries. And this includes the central banks of Australia, Malaysia, Singapore, and South Africa. There is also another initiative that is called Project mBridge, which involves China. And this is an attempt to connect the central banks of Thailand, the United Arab Emirates, and mainland China, and also Hong Kong, which has its own monetary authority. It's part of China, but has a separate monetary authority. And Saudi Arabia recently joined this initiative as well. And there are an additional 31 observing members, 31 central banks in other territories around the world that are interested in joining this program that is essentially using blockchain technology, DLT, distributed ledger technology, and using central bank digital currency, CBDCs, to connect these central banks so they can settle trade imbalances. This is a graphic demonstrating how the system works. So companies in mainland China, they have their own accounts at local banks. And companies in the United Arab Emirates have accounts at their local banks. And then exporters and importers from those countries can trade with each other, right? But in order to settle trade imbalances between China and the UAE, these central banks can communicate directly, and they can use CBDCs to settle those trade imbalances. And this cuts out all middlemen. It cuts out all other institutions. It simplifies the process and makes it basically free. And it also means that it's sanctions proof. If the US wants to sanction China and sanction its trading partners, well, they can keep trading and they can settle trade imbalances through mBridge using central bank digital currencies. They don't need the SWIFT system. And this is why Bloomberg referred to the mBridge system and the digital yuan as a, quote, challenge to US dollar dominance, end quote. And by the way, this is one of the reasons why Wall Street is lobbying so hard against central bank digital currencies. And Wall Street banks are saying that if central banks start adopting CBDCs, it could drain money from the banking system, not only in the US, but in many other countries, especially because if you're allowed to have a retail CBDC account at a central bank, that means that you will be paid whatever the interest rate is set by the bank, you will be paid that on your account. Whereas the average interest rate that you get paid by a bank, a private bank in the US, and a savings account is 0.4%. But if you had a retail CBDC account, you would be paid over 4% by the central bank. So this would drain liquidity from the private banks, and that also they're making so much money by holding all of this money and then lending it and then paying almost nothing to the depositors. So they profit. So of course they're against actual competition. Again, another example of how capitalists don't really want competition. They want monopolies. So all of that's true. But another reason why Wall Street is lobbying against CBDCs is because they understand that this could help further fuel de-dollarization, which will hurt their bottom line. It will reduce the global demand for US financial assets, which will reduce their value and reduce the wealth of the rich. So you can see that all of these issues are closely related. And this report on the BRICS proposal for a multi-currency system, it emphasizes, Russia argues that the best option would be creating some kind of peer-to-peer structure that will lower transactional costs and offer better stability due to its decentralized nature. And this brings us to the proposal of the BRICS Cross-Border Payment Initiative. And the report notes that there currently is a BRICS Payment Task Force that already exists. And what they're working on, what the proposal will do, is accelerate and facilitate cross-border payments between BRICS countries, provide innovation and new technology, expand financial inclusion, and increase the share of national currencies in not only cross-border payments, but we're going to talk here about cross-border investments. Because when we talk about de-dollarization, we have to distinguish de-dollarization of payments and de-dollarization of savings, of investments, right? I talked earlier about how China and Russia are trading in their currencies, Russia and India, Russia and Iran, Brazil and China, the ASEAN countries, African countries are trading using their own national currencies. Well, what about investments? That's only one solution. We also have to have more of a diversity, so people are not only holding their savings in the form of US dollar denominated assets. So in this report, the Russian BRICS report calls for the introduction of a new system of securities accounting and settlement and a demonopolization of the existing system. This leads to another institution that the Russian BRICS chairmanship has proposed, which it calls the BRICS Clear platform, which it describes as an electronic system of interdepository interaction. So what this would do is it would provide a record-keeping system for all members, and it would be automated. It would automate execution of orders so they cannot be intercepted, and it would ensure that there is an absence of officials making decisions on conducting or rejecting transactions. So it would be decentralized, democratic, and equal, and open. They emphasize openness. So it would remove the possibility of blocking transactions, of sanctions. They want to get rid of the problems that exist, which we see with the US and Europe trying to sanction the entire world, basically, anyone who doesn't agree with them. What this would also clarify is that the BRICS Clear system could only have its rules changed by the unanimous decision of all participants. So again, it's completely democratic. It would provide a unified system and format of information exchange. And here's the very important part. It will provide investments in previously unavailable financial instruments. It calls for the creation and development of an investment hub on each continent of a platform member country, providing investment opportunities in Africa, in Latin America, in Asia. So this is a way of encouraging investment in infrastructure, in different projects that is needed, and not simply investing in financial assets and treasury securities in the United States, in Europe, in the rich countries, that they don't need more capital. It's the developing countries that need more capital to industrialize and to build infrastructure. And as part of the BRICS Clear platform, it calls for new forms of debt issuance to replace the current system of euro-denominated bonds and US dollar-denominated bonds. That's euro-dollar, so that's foreign. When they say that, I mean the bonds that are denominated in a foreign currency. So for instance, if Argentina wants to borrow, it will sell investors on Wall Street sovereign bonds backed by the government of Argentina, but they are denominated in US dollars, which obviously the Argentine central bank cannot print. So instead, this proposal is to create new forms of debt issuance and potentially denominated in national currencies. This has been a demand of developing countries for decades, saying we want to be able to borrow in our own local currency, which will make it much easier for us to industrialize and develop infrastructure, because we don't need to get access to a foreign currency to pay for this. So this report calls for BRICS to establish a new independent organization which is an alternative to the ANNA, the Association of National Numbering Agencies, which will allow assigning and maintaining international codes for financial instruments denominated in the national currencies of BRICS member states. So this is an easier way for investors to have opportunities to help to develop in developing countries, in poor countries, in BRICS members. And this also proposes the facilitation of cross-border trading of commodities, establishing different commodities trading platforms, including what they call a BRICS grain exchange. And this gets back to the idea of saying, okay, fine, if we want to settle trade imbalances and you don't want the currency of India or the currency of Russia, instead, you can settle trade imbalances through not only commodities like gold, you can settle trade imbalances through grain, because you can't eat Indian rupees, but you can eat Indian rice and other Indian agricultural products. So we should have a way of being able to settle trade imbalances through commodities. Now, in terms of de-dollarization of savings, another very important issue is de-dollarization of the reserves held by central banks. This is a complicated issue because the US dollar does still dominate the reserves held by central banks around the world. According to the IMF, it makes up 59% of the reserves of central banks held around the world. That is a lot, although it has declined by over 10% in the past 2 decades. So in terms of this problem, this BRICS report emphasizes that reducing the reliance on the dollar as a share of reserves will happen in a measured manner. That's a way of saying that it's going to happen slowly. It's not going to happen overnight. But they emphasize that what should be done is making other countries' currencies or a basket of such currencies more attractive as a store of value. And it proposes several ways to do that, including creating a liquidity provision mechanism that would allow other countries to convert their holdings promptly and efficiently, and also creating a market, a trading venue for different currencies that will provide sufficient capital reserves. And this brings us to one of the more controversial proposals in this report, which is the proliferation of fixed income instruments denominated in local currencies to serve as an investment vehicle. So what does that mean, translated from econospeak? What that means is that a fixed income instrument is typically a bond. It's some kind of instrument that gives you fixed income. Like every year they pay you a certain interest rate, right? Those are typically government securities, or they could be corporate bonds, right? So what they're saying is that BRICS should encourage different bonds that are denominated not only in dollars or in euros, but in the currencies of China, renminbi, denominated in Indian rupees, denominated in Brazilian real, instead of only selling those bonds denominated in euro dollars, that is, in offshore dollars. This would be a very important step in developing countries so they could help maintain their balance of payments. It's been a demand for a long time, but it's controversial because a lot of central bankers don't want to hold these kinds of instruments because they're worried that the value of the currency in which these assets are denominated will depreciate over time. So, given the fact that central bankers would be very wary of this proposal, the report proposes another idea, which is that the BRICS Bank, the New Development Bank, can create a new digital asset, which it calls the BRICS Digital Investment Asset, which would be backed by assets committed by BRICS constituents. So this provides another kind of financial instrument that could be used to hold value, and it's going to be backed by the assets of the BRICS Bank. Now, on the subject of the New Development Bank, BRICS has made it very clear that they want to strengthen the bank and expand its operations. And this report emphasizes that the New Development Bank was created in order to help poor countries address their infrastructure challenges. And it is committed to lending more in local currencies. Its current goal is to reach 30% of approved loans being denominated in local currencies by the end of 2024. And from 2022 to 2026, it is promising to have 30% of its loans distributed in local currencies. However, over time, it wants to further reduce the reliance on the US dollar. And this report emphasizes that it must migrate to alternative payment and investment infrastructure, which is why the Russian BRICS chairmanship proposed creating this BRICS digital investment asset. And it also proposed substantially increasing the NDB's financing capacity to further help developing countries and to weaken their dependency on the World Bank. So as I move toward wrapping up soon here, I'm going to summarize a few of the main proposals that have been introduced by Russia as the chairman of the BRICS system. First of all, a multi-currency system and the creation of a BRICS cross-border payment initiative. This includes the creation of a BRICS Clear platform and more opportunities for investment in newly created financial instruments, assets that are denominated in local currencies of BRICS members. And while Russia is advocating for using blockchain technology and central bank digital currencies, it has also proposed the opening of exchanges using gold, grain, and other commodities to settle trade imbalances for countries that don't want to settle trade imbalances with national currencies. The report also calls for strengthening the new development bank, the BRICS Bank. It proposes the creation of a BRICS digital investment asset backed by assets committed by members of BRICS. And it advocates for reforming the BRICS IMF alternative, which is called the CRA, the Contingent Reserve Agreement, which was created to resolve short-term balance of payments issues in BRICS members or other countries that want to borrow from it. However, the report emphasizes that the problems that exist with the CRA, the IMF alternative, is that one, the IMF has authority over it, and two, it is based on the US dollar, and it is built around the SWIFT interbank messaging system. So the CRA needs to be fundamentally transformed. Those are the main points raised in this long report, but there's one other major issue that I want to conclude with, and that is the big question that people have been debating for years now, which is, will there be a single BRICS currency? This report definitely does not close the door. It does not say that BRICS is opposed to the idea, but it points out that it's a very complicated issue, that there are a lot of problems and logistical issues in getting something like that set up. And it discusses a possibility for something that could serve as a kind of international unit of account that could potentially replace the US dollar as a single global reserve currency if countries are interested in that in the future. Although, again, in the short to the medium term, it is proposing using national currencies in trade and settling trade imbalances through national currencies, through commodities like gold or grain or other commodities, or through the creation of new investment assets, new financial instruments, including some issued by BRICS itself. But let me briefly discuss the issue of the special drawing rights. This is a little technical for people who don't follow international economics, but the special drawing rights, the SDRs, are the international reserve asset issued by the IMF. And despite all of the many problems that exist with the IMF, which I've discussed in great detail already, this is a very interesting idea that is similar to the proposal made by John Maynard Keynes, the renowned British economist, at the Bretton Woods Conference in 1944, which would be an international unit of account that could be used to settle trade imbalances. And as John Maynard Keynes had proposed it, he called it the Bancor, and he said that the value could be determined by a basket of currencies. Well, there's something similar that exists, which is the IMF's SDR, and the value is based on a basket of 5 currencies. So it's the 4 major currencies: the US, the euro, the British pound, the Japanese yen, and then also the Chinese yuan. The Chinese renminbi was recently added, but this is still, the SDR is still heavily weighted toward the Western economies. So it's a step in a potential direction that could be positive, but it still needs to be fundamentally changed in some important ways. As this report emphasizes, that the original purpose of the SDR was to become the alternative reserve asset and even the new global currency. However, use of the SDR remains limited, largely because the United States has fought tooth and nail to oppose the expansion of the use of SDRs because it wants to maintain the dollar as the global reserve currency. What's interesting is that this report notes that China has actually begun reporting international reserves, balance of payments, and international investment position data in both SDRs and renminbi as an alternative to the dollar. And China has actually issued SDR-denominated bonds. However, one of the big problems is that SDRs are not used in markets. There is no market infrastructure. SDRs are overseen by the IMF. Each country has an account with the IMF, and they have a certain amount of SDRs in their account. But local companies and importers and exporters in countries do not have access to those SDRs. It's only the governments themselves. So this is strictly limited to governments settling trade imbalances. And really, in the case of the IMF, it's governments that are borrowing money from the IMF to settle their balance of payments problems, to pay for imports and such, to make sure their currencies don't collapse. Or it's countries that are paying off the debt that they owe to the IMF. So the first step toward wider use of the SDRs would be creating market infrastructure. But it's not just that. Another problem with borrowing in SDRs is that they are impacted by the high interest rate environment of the countries that make up the basket of currencies. Again, the US, the Federal Reserve, and the European Central Bank raise interest rates very rapidly, which means that countries that, even if their debt is not only denominated in dollars, if it's denominated in SDRs, they still have to get access to the currencies that make up the SDRs in order to pay off that debt to the IMF. And that has resulted in significant downward pressure on the currencies of many of these developing countries. So now at the same time, what's interesting is this report, this BRICS report, is not critical of the SDR. It's not opposed to the SDR. It argues that the SDR can help to eliminate the inherent risks of credit-based sovereign currency and make it possible to manage global liquidity. And when a country's currency is no longer used as the yardstick for global trade and as the benchmark for other currencies, SDRs can help because the exchange rate policy of the country would be far more effective in adjusting economic imbalances. This would significantly reduce the risks of a future crisis and enhance crisis management capability. So what this is saying is that if a country has a depreciating currency and they raise interest rates to try to reduce the inflation in their currency, in their country, if their currency is not always constantly being traded back and forth in the foreign exchange market, and you have speculators trying to make money off of the arbitrage opportunities and to speculate against their currency, putting downward pressure on their currency, it could actually help increase the monetary sovereignty of these countries if the SDR is a more widely used asset, which would put less downward pressure on their local currencies. However, as we discussed earlier, the IMF has a lot of problems. It's deeply undemocratic. It's dominated by the Western countries. The IMF managing director has always been European, and the US is the only country with veto power. So this is one of the big problems with the SDRs, is that they're still being overseen by the IMF. However, all of that said, at the end of this long report, the Russian Finance Ministry and Central Bank emphasized that SDRs should play an important role in the economy, that they should play a bigger role, and they argue that the SDR has the potential to act as a super sovereign reserve currency, and it might be a solution to the long-standing Triffin dilemma, which I discussed earlier, which is the problem that issuing countries of the reserve currency, that is the US dollar, cannot maintain the value of the reserve currency while providing liquidity to the world. That's a way of saying that because the dollar is the reserve currency, the US has to maintain huge current account deficits, trade deficits with the rest of the world, in order to provide the rest of the world with the dollars, with the liquidity that the rest of the world needs to use the dollar as the reserve currency. So that's the Triffin's dilemma. And this report emphasizes that the SDR could be a solution. So what they're really saying is that we're not opposed to this idea of having an international unit of account, of John Maynard Keynes' idea of the bond core, or in the future of creating some kind of BRICS currency that is used. They want to promote the use of the SDR in international trade, commodity pricing, cross-border investment, and bookkeeping. They want to create more financial assets denominated in the SDR to serve as an investment vehicle. So I think the reason that the Russian Finance Ministry and Central Bank decided to conclude this long 48-page report with this discussion of the SDR, I think the reason they decided to do that is because what they're really saying is that we're not opposed to the idea of a global unit of account, like the bond core, or like a more democratized SDR, if the IMF is no longer dominated by the West, or if other currencies are included in the basket. This is actually a good idea. They're saying that this could be the solution to the Triffin's dilemma. So what they're saying is that we're not opposed to the idea of a BRICS currency. It's still on the table. However, this is something for the long term. It's not going to happen in a few years. It may happen in a few decades. Maybe sooner, but I think what this report makes very clear is that there are alternatives that not only are being developed, they already exist. They're being strengthened, they're being reformed. There's the BRICS New Development Bank, there's the BRICS CRA, which will be reformed. There is this proposal for a BRICS cross-payment infrastructure platform, for a multi-currency platform. There are all these proposals, new investment assets, a new clearing facility, new commodities trading houses to settle trade imbalances in commodities. There are so many different ideas that have been proposed that are being worked on in BRICS. These are the kinds of things that are discussed in BRICS summits, like the summit in Kazan in Russia in October. And these are the kinds of things that will continue to be debated by members of BRICS, especially as BRICS continues to expand. But I want to conclude here because this episode was way, way too long. When I planned going through this long report and highlighting and making all my notes and getting all the graphs together, I did not plan on it being this long, but I felt like it was important to go into granular detail explaining how some of these institutions could work, because I get asked a lot about what de-dollarization means tangibly, about what alternatives do truly exist. And I wanted to provide that in a very long episode here. I'm sorry if I bored people. I'm sorry if I went over the head of some people who are not familiar with some of the financial jargon. I tried to simplify it and make it understandable and palatable for an average audience. But I need to conclude here. This has been very long. I am Ben Norton. I am the editor-in-chief of Geopolitical Economy Report. Please like and subscribe. Please share this. And I will be back soon for much more reporting. Thanks for joining me to the end of this very long episode. I will see you all next time.